Welcome, everyone. My name is Connor Kitko from the team here at YCharts. I'm joined by my colleague, Joe Clevin, Senior Marketing Analyst here at YCharts. How you doing today, Joe?
Doing well, Connor. Thank you for asking and excited to be here with you. We got a lot to talk about from Q2, so ready to dive deeper into it with you.
Absolutely. Talking about Q2, since the month of July and a little bit into August, at least the market conditions have definitely improved from some of the data we're looking at. But as we're all trying to see where the economy will go next, got a lot of good data to dig into. And as we do every quarter, we are reviewing the YCharts economic update deck, tons of visuals and data summarizing the second quarter. And our hope is that this is going to help you all navigate whatever is in store for the rest of the year. If you are a YCharts client, I want to show you just really quickly how you can access this deck. So starting from your dashboard, hover over support and resources. And on your left-hand side here, you see economic summary deck. Very easy to download this deck or a previous version if you'd like. And if you are not a YCharts client, don't worry, you can still get access to a free shortened version of this deck. The best way to do that would be to go to our blog and look for that most recent economic update post where you can download the shortened free version. Okay, a couple quick reminders before we jump into the good stuff. All this data that we're reviewing, nearly all of it is as of the end of Q2, so June 30th. We do have some commentary on how some things have changed since this data was pulled down. And then also housekeeping, you can use the Q&A at the bottom of your screen to submit any questions. Joe, myself, or the team at YCharts would be happy to take those. And we will be emailing a recording of today's webinar to all attendees. So you can expect that to hit your inbox tomorrow. And we'll also be posting the replay on our YouTube channel. So head over to YouTube, like and subscribe YCharts so you don't miss out on any of these economic updates or any other of the great video content we post there. Okay, gonna end that soapbox and now I'll pass it off to Joe to get us started with some market data.
Super. Thanks, Connor. And yes, let's take the plunge and kick things off with some charts showing performance of major market indexes. U.S. stocks fell further in Q2 after a similarly red first quarter of 2022. The S&P 500 dropped 16% in Q2 alone, and the NASDAQ composite was hurt the worst with a 22.3% decline in the second quarter. International picture was much the same, with the MSCI World ex-USA index falling by 14.4% and emerging markets hanging in there relatively speaking, but still ending the quarter 11.3% lower. Now going to layer deeper into sectors, not a single S&P sector posted a positive return over the course of Q2. All 11 were in the red. The defensive sectors held up best, with consumer staples finishing the quarter about 4.2% lower. And after an exceptionally strong Q1, energy also sank, but only by about 5.5%. Hit hardest, however, were the technology, communication services, and consumer discretionary sectors, all of which fell by around 20% or more.
Yeah, very interesting, Joe. Definitely worth noting, NASDAQ up the most since the start of July or the end of Q2. And then also very interesting, but expected to see those defensive sectors, the degree to which they're outperforming sensitive and cyclical. Very cool stuff there. We're going to jump now into some asset class performance. And this table, this quilt, shows the performance of key asset classes over some different look back periods. And as we mentioned, this data is as of June 30th. And so you'll notice that our year to date and 6-month total return columns are showing the same figures. Commodities have once again led the pack. They returned 2% in Q2 and as the only positive asset class on the quarter. Now they are up to a 35.8% total return for commodities on the year. However, if you look over to the rightmost column over here on a 10-year look back, we see that commodities are actually negative over the last 10 years. So it shows that this is definitely a recent trend for the asset class. And we also see in the bottom left here, US growth hit the hardest, a 20.9% drop in Q2, making for a negative 28% return year to date. And finally, quick, some other comments.
Real quick, Connor, if I could jump in. We are getting some Q&As here in the chat that your screen might be frozen, or our screen in general. You might want to just check that to make sure we're on the correct asset class table there.
Thank you for that. Okay, is it resolved now?
I was seeing it fine on my end. It looks like we are okay now.
Okay. Apologies, everyone. It's a faux pas on my part. Let me see if we can get back. We'll quickly review some of those charts that Joe showed us when we looked at sectors, sensitive sectors, cyclical sectors down the worst in Q2, but those defensive sectors, staples, utilities, and healthcare holding up considerably better, still down on the quarter. And then here's when we jumped into that asset class performance, and I'll just reiterate some of those key takeaways. Again, apologies for that technological error here, but commodities up 35.8% on the year. And over the last quarter, the last 3 month total return, just up 2%, but still the only asset class to be positive in Q2. Looking down to commodities over the 10-year total return, trailing 10 years, still not positive. So it's interesting to just see that disparity in the short and long term. US growth down the worst, and then US value leading all equity asset classes year to date. Okay, now I'm going to try something. I hope this does not break our screen share either, but I did want to jump into YCharts for a quick second and show you guys a new Excel template, a pre-built template that we have available. It's called our investment heat map here. So if you're looking to create those asset class quilts like we just went through, here's a place that you can come download this template. If you have the YCharts Excel add-in, all of that data will populate and sort itself automatically. Okay, back to the data. Same information, just presented in a different format here. So now we're looking at a quarter over quarter view for the last 15 calendar quarters. And this slide is really great for teasing out some trends in asset class performance quarter over quarter. One of which being the volatility of US growth. You can see in these dark red tiles, growth is typically number one or number two, or it's, as of late or back in 2018, considerably disappointing. Another interesting one is this trend in the real estate asset class. US real estate has this slow but steady rise up to the top of the table at the end of 2021, and then down relatively to the bottom half of the table here in the last 2 quarters. So interesting to see those two asset classes trending over time. Passing it back to Joe now.
Thank you, Connor. Yeah, indeed, to see the 180 that US growth has taken over the past couple quarters, and the S&P 500 as well at its lowest level on our asset class matrix here in the past X quarters there, looking back. So something to keep an eye on as we go forward. But now on to our performance of diversified portfolio look back. So on a trailing 12-month basis, this slide here points out various risk versus return strategies on that TTM basis. We have here stock to bond allocations of 80-20, 50-50, 20-80, and an all stock S&P 500 portfolio. The S&P 500 fell further down nearly as much as 23% from its all-time high logged on the very first trading day of 2022. Of the bunch, the 20-80 allocation was the best over the previous year, but still down 10.5%. And this visual is just one of the many that demonstrate the value of diversification and what it can provide investors during these turbulent periods where months can be very down and then with significant rebounds, both across the stock and bond markets.
Yeah, definitely interesting to note that the diversification benefits still holding up despite both equities and bonds, having a rough go of it lately. Great. We're going to move on to some bonds and interest rates. Very apropos. Here we go. Our blue table on the left here shows how a bunch of key interest rates have changed over the last few quarters. And on the right, we're looking at the yield curve as reflected as of 6/30 is in green. 3 months ago, so end of Q1 is in yellow. And then 1 year ago, that's how the yield curve looked in blue. So the second quarter of 2022 brought a lot of action to the yield curve. Treasury rates continue to rise across the board, evidenced by all those green arrows in our table here. And they rose by so much so in the short end of the curve that very flat beyond this 3-year mark and to the point of inversion for some of these key spreads. So the 5-year Treasury rate ended Q2 at 3.01%, which was greater than the 10-year rate's 2.98% yield, and just shy of the 30 years 3.14%. We know that inverted, flatter yield curve can indicate a lot of uncertainty about economic growth in the future in the long term. And we also know that since pulling down this data, the 10 to 2-year Treasury yield spread has further inverted. It kind of bounced around a little bit and is now inverted. So if you're worried about a recession, that's definitely one of those common indicators that people like to look at.
Indeed. And if you go to our YCharts blog as well, we recently wrote a piece about the inverted yield curve and what it means for the markets and in historical context as well. So definitely worth a look there if you'd like to learn a bit more about the implications of those inverted yield spreads.
Absolutely.
So now pivoting to macroeconomic data, let's start off here with looking at this heat map of various economic data points that are considered leading indicators and show their trends over time. The first 6 columns here show a quarter by quarter change, whereas the last 13 columns show annual changes in the data dating back to 2008. Notable on this heat map is the US Index of Consumer Sentiment at its lowest level in more than a decade, sinking to 50 at the end of Q2. A little later on our presentation today, we'll show how low this consumer sentiment level really is, dating back to 1953, when the University of Michigan first published the sentiment level survey. So be sure to stick around for that. It's quite revealing. The 10 to 2 Treasury yield spread continues to hover around 0, like you just mentioned, Connor, inverting for the second time this year, just after the end of Q2. And lastly of note, the Philly Fed Manufacturing Index has also dropped below 0, signaling contraction in the manufacturing sector, which is something else to keep an eye on. I'm going to take a quick pause right here and bop into YCharts for a couple seconds and just take an extra look at that consumer sentiment data point that we have. Notable here is that we do have very expansive data all within YCharts, but specifically here, looking at consumer sentiment at an all-time low dating all the way back to 1953. And it doesn't just stop there with the consumer sentiment index. Notable in YCharts, we do carry data points from a vast array of sources, including the University of Michigan, which does produce pretty renowned sentiment indexes, such as this one where the expected inflation change over the next year and the next 5 years, all there to help you paint a picture of where the economy is headed, where it's been, and to make smarter investment decisions in your research analyses.
Absolutely. And we'll just call this out because it's so topical, but this is, basically saying that based on the survey, people are expecting 5.2% of inflation over the next year going forward. And then on an annualized basis, 2.9% inflation annualized over the next 5 years. So definitely a positive outlook on the current inflation picture, even though consumer sentiment at an all-time low. So what do you make of that?
And hopefully that consumer sentiment number will tick up, assuming that inflation rate stays low over the next year and few years, and our wallets feel a little bit less crunched at the checkout counter. So next here, we have this slide showing the trade activity between the USA and other key partners. We do see that the US trade balance on goods and services continues to reach new all-time lows. The chart on the left shows that US imports have climbed significantly higher than pre-pandemic levels, now just shy of 1 trillion per quarter at 988.41 billion to be exact, and US exports have also exceeded pre-pandemic levels. The chart on the right shows how this divergence of trade imports versus exports is causing the lowest trade balance ever recorded in US history. And the table below finally shows how imports have increased year over year in ex-US regions. At the end of Q2 2022, we do see that services imports from Mexico had the largest increase year over year at 55%.
Very interesting stuff. International trade picture, especially with where the dollar is at right now. More on that later. All right, looking here at some housing market data, the beginning of 2021, we saw the lowest 30-year mortgage rate in decades. And since then, mortgage rates have shot higher, ending Q2 at 5.7% here on our chart on the top left. Looking at some additional housing indicators from the National Association of Home Builders, NAHB, we have the US Housing Market Index in green. We also have traffic of prospective buyers in purple, along with present sales conditions and expected sales conditions in the orange and, the blue and the orange. So calling your attention to, I did want to call out that those are all back or below their pre-COVID levels. But despite these two top charts, high mortgage rates, all of these housing market indicators being down, this first line of our table at the bottom, the Case-Shiller Home Price Index, still up 1.5% over the last month, 5.7% over the last quarter, and the housing price index up 20% over the last year. So despite all these conditions and headwinds, average selling prices are still remaining high. Onto that dollar topic, like we just mentioned, looking at our four charts in the bottom here, the US dollar to euro, to pound sterling, to Chinese yuan, and to the Japanese yen, those exchange rates have all increased to near 52-week highs at the end of Q2. And a quick update, in early Q3, the US dollar approached, and I think barely even reached, maybe for half a day, that near parity with the euro. That hasn't happened since 2002. So that was definitely exciting to see if you're considering that European family vacation coming up this summer. You might get more out of your buck abroad than here in the US. And to illustrate that point, looking at the chart up top here, despite that ICE US dollar index in green, which measures USD against a basket of major world currencies, despite that increase over the last couple of years, we've also seen a greater increase to the consumer price index, and thus the purchasing power of the consumer dollar is suffering because inflation is killing us all.
Indeed it is, and maybe it does illustrate the fact that there are some bargains to be had in Europe if you are taking that family vacation this summer. So do watch for those, and we'll see if the euro can hold this line with the parity of the dollar.
Absolutely. Okay, charts of the moment. We're getting into some of the fun stuff, which are pulled down by the team here at YCharts. We like to tease out some of those key storylines from the quarter and use, some top-notch visuals and data to illustrate them for you all. I'm going to pass it off to Joe with this one.
Indeed. Thank you, Connor. Yes, was sure fun, the team at YCharts pulling these. And this section certainly is a fan favorite, as it does illustrate charts of the moment, things that are relevant to our current quarter, even month and era going on right now. So let's start off here with this one that we entitled Wishful Thinking. And the big takeaway here is that since 1950, the S&P 500 has fallen in the first half of 23 calendar years and risen in the first half of 50. Now, of those 23 years in which the index has fallen, the S&P completed a comeback in just 8 of them, the most recent of which came just 2 years ago in 2020. And whilst going 8 for 23 means the S&P has converted a negative first half to a positive full year about 35% of the time, 2022 is the third worst first half since 1950 for the S&P 500, down 20.6 at the half, and in technical terms in bear market territory. Only in 1970 did the index come back from such a poor start, a year in which the S&P 500 just eked out a gain barely, finished 0.1% there in the black. And if you want to explore some of these insights further about the first half of the year, be sure to head back to our blog and check out our post on highlights, lowlights, and insights from first half of 2022, where we featured this chart along with several other insights covering top stories from the first half of the year. One thing we will do is hop into YCharts for a quick second just to illustrate some of the intricacies and nuances of this chart, since it is quite captivating. One disclaimer to make here is that we did use our very intuitive custom securities tool in order to sort of manufacture this chart to a certain extent. You will notice that we used custom levels pertaining to certain years for the S&P 500, 1970, 2010, all the way through 2020, 22 to illustrate the first half of this year versus all those other years in which there was a down first half and the index did come back. Inside the custom securities tool, the dates used were a bit arbitrary to kind of mimic that first half versus the full year for these other years. But it is certainly possible to make your own analyses and insights using the custom securities tool, and it'd be worth checking out if you haven't done so yet. One last thing I'll touch here on this chart is our new area chart tool. All you have to do to get that purple shading and enhance the visual aspects of your chart is just hop into the annotate section there at the top left corner, click on annotate, and the settings gear for the particular index or metric or security that you would like to change, and just toggle area chart from off to on. And just like that, in a couple clicks, you've been able to enhance the insight or visual that you'd like to share with colleagues or clients, all in a matter of clicks.
Very nice,
that does it for some wishful thinking, and hopefully we can see that comeback start here. We've seen some good flashes of it in July. Let's see if we can end this year in the green as well. Connor, I'll switch it over to you for some inflation data. Can't wait to see what we have here.
That's right. Just, actually not even showing inflation per se on this chart, but in our top panel, we have US average hourly earnings, and in the bottom, US real average hourly earnings, so accounting for inflation. Though that wage growth was definitely a big factor in post-COVID world that we're living in now, other inflation inputs have risen faster, such as food and energy costs, two of the largest factors for that consumer price index and the inflation number. As a result, real average hourly earnings saw a really good uptick when COVID first, landed and changed our worlds. But since that recovery has really begun and inflation has taken off, the picture has just gotten worse for American workers in terms of that real average hourly earnings. Back below pre-COVID levels, always interesting to compare any indicator, any security to its pre-COVID levels. That's a good way to add some context. And now we're talking about consumer sentiment. So we did allude to this chart earlier. The current most latest print for consumer sentiment, 50.0, lowest level on record, lower even than amid the 2008 financial crisis. And this sentiment indicator, that's the second lowest print, came in the early 1980s, as we see here. Similarly, an energy crisis was occurring in the US. Gas prices were really crippling US consumers, but again, even worse consumer sentiment now than we saw back in the 80s in the 2008 financial crisis. So really just shows how this current environment has been affecting consumers.
Certainly has, Connor. This is one of my favorite charts personally, and not because of its merits. You hate to see consumer sentiment so far down in the dumps, but just the thought of dating back to 1953, according to this University of Michigan survey, the consumer has never felt gloomier since then. So really an exclamation point to be had there.
Absolutely.
So now taking a look at some major market losses here of the S&P 500. So drilling down on these tables here, it's no secret that the S&P 500 is market cap weighted, and an outsized percentage of market cap losses can be attributed to its largest constituents, the FANG M stocks. Those are, after going through several re-nomenclature cycles, it's now Meta Platforms, Apple, Amazon, Netflix, Alphabet, and Microsoft, currently making that FANG M cohort. And they're responsible for a combined $3 trillion of lost market cap. And the index's top 25 losers, which are still just 5% of all the names in the S&P 500 index, contributed 61% of market cap losses in the first 6 months of 2022. And examining the S&P 500's top 10 losers by market capitalization, we also see that Apple, Amazon, Microsoft, and Tesla have been leading the index lower most on this list. And the top 10 losers are responsible for about half of that market cap loss to the S&P 500 through the first half of 2022. So it really just goes to show that in an index of a little over 500 names, a lot of the index rather is at the mercy of just a handful of names. Now, taking a look here at some supply chain woes, this has been a pretty persistent story for several months now. And we look at recent inventory crunches, which have allegedly drove price increases in inflation, at least in part. They're starting to ease as the percentage of held inventory to sales volume moves higher for wholesalers, businesses, and retailers all alike. Coming off those lows in the mid to early to late parts of 2021, we do see a little bit of a lift there in US wholesalers inventory to sales ratio, the same for business and the same for retail trade. So are we at the end of the tunnel yet for some of our supply chain constraints that have been talked about so often? Time will only tell, but it is good to see a little bit of a reversion to the mean happening there and some improvement off those lows in the recent months.
There are lots of motivation to get these corrected in time for holiday shopping, back to school shopping, all those things coming up at the end of the year. So we'll see how that plays out. Okay, talking again about our interest rate situation. On the left is the 10 to 2 Treasury yield spread. On the right, we have the 2, 5, 10, and 20-year Treasury rates. So we talked about this before. However, just early July, the 10 to 2 spread started to invert, bounced around a little bit, and now it is inverting, and even more so. I think it's about negative 0.4 or something at the moment. Another indicator, another spread commonly watched as a recession predictor is the 10-year to 3-month Treasury yield spread, also in YCharts. Not pictured here, it's not inverted quite yet, but getting very close. And while neither the 10-2 nor the 10-year to 3-month are perfect predictors of recessions, it is highly accurate at predicting based on historical data when both invert. typically you will see a US recession following when that happens. Just taking note too of the majority of the rates on the right chart are above 3% now, big benchmark for the 10-year. And then we can also see here the interplay of that 2-year treasury rate in purple and the 10-year rate in blue. When the purple line catches up and then surpasses that blue line, that's the 10-2 inversion occurring as well. Okay, more on the inflation topic. This is actually taken from our good friend Ben Carlson over at Ritholtz Wealth Management, also on Animal Spirits podcast, and he has a portfolio rescue podcast and YouTube show as well. He made a very insightful comparison between inflation in the 1970s and the inflation that we're seeing right now. And his insight was that inflation was actually nominally higher in the 70s and early 80s than it is today, but the state of interest rates, the state of income could not be more different. That's because there is just such a gap now between that inflation rate and the 10-year treasury rate, for example, but also any kind of savings CD rate, even shorter term rates like the 3-month or the 1 year. There are just many fewer opportunities to earn income these days than there were back in the 70s and 80s, possibly why this current inflationary environment is stinging so bad. And Ben also noted that the mortgage rate, it's kind of shocking to look back at 12.9% mortgage rates while we're here complaining about in the 5.5 to 5.75 range. But his point was that home prices should also be considered here, because home prices were much lower back in the 70s and 80s, even on a relative adjusted basis, and therefore monthly payments and the cost of home ownership was actually a lot lower, even though mortgage rates were considerably higher. So really insightful comparison between two situations. Again, similar inflation environment, similar energy crisis going on. However, the picture with interest rates, with fixed income yields, is markedly different. Okay, Joe, take us home.
Yeah, and I certainly know that the median home price in the US has just gone to all-time high after all-time high too. So again, just a different era that we're in, albeit the same, but still different since back then. We will take us home here with one last chart for all of you crypto fans or dissidents perhaps out there, depending on what side of the field you're on. Over the last 12 months, the crypto winter has really taken cryptocurrencies by storm, with Binance Coin down 27%, Bitcoin 44%, Ethereum nearly 50%, and Cardano down 66% from their levels a year ago, hailing from their COVID highs. The main takeaway here is that, simply put, major cryptocurrencies, once high flying, are now down drastically in 2022. And so it always pays to look at these ever-changing cryptocurrencies if you are invested in them, looking to get into them. Certainly the winter has taken storm, and not sure when the end of the tunnel will be for these cryptocurrencies, but make sure you bundle up if you are invested in these cryptocurrencies.
Yeah, people talk about the crypto winters. It seems like there's a crypto winter every quarter, but it's a good, fun way to describe the extreme volatility there. Before we wrap things up here, did want to answer one question that came through from Julie. Why is consumer sentiment so low? Is it realistic? What else could be impacting how people feel? $1 million question. I feel like I would, it's at the end of the day, it is a survey. Surveys are not, certainly University of Michigan probably has it figured out, but it is just how people are feeling more than how they're being personally impacted by things like inflation. An interesting point on that is I've read about calculating your personal inflation. If you don't own a car, if you don't own a home, then inflation probably feels a lot different for you. So there could be some factor of that, just everyone's hearing about inflation without really going into the details of how it's impacting them in particular. Good question, Julie. I wish I had a more informed answer for you. Well, everyone, thank you again for joining. Thank you for putting up with my technical difficulties at the beginning there. Once again, if you want a copy of this deck, we're emailing it out tomorrow. Check it out on YouTube and don't forget to hit subscribe. And once again, very excited that you decided to join us. We hope you have a good rest of your Thursday and weekend.